Good morning and welcome to Market Monday for June 30th, 2025. And just like that, the first half of the year is a wrap. As we all know now, the U.S. conducted military operations designed to destroy Iran's nuclear bomb-making capabilities. Naturally, the S&P 500 stock market rose 2% over the following two-day period, while crude oil fell 12% and the volatility index fell 15%. Not exactly the reaction most would expect, right? And this is the main reason that we don't jump in and out of positions based on news or events. The short-term market swings are just too unpredictable. Therefore, as investors, we tolerate short-term volatility to achieve long-term return better than cash or bonds. Speaking of military operations, in the days following the attack, NATO allies agreed to increase defense spending, targeting 5% of GDP. This is going back to 1961. You can see the US, in gold, used to spend almost 10% of our GDP on defense, a number that's now come down to about a third of that at 3.4%. Here's the EU and Canada. EU down at just 1.6%, and Canada at 1.3%. If EU countries quadruple spending, the ripple effect on their budgets could be dramatic. So could this defense spending shift be contributing to equity returns abroad? While the US stock markets are back in positive territory for the year, way down here, what are the top performing countries this year? We now have a new year-to-date winner, with Greece up 45%, Poland and Spain up right around 40%, Austria, Italy, Germany, Norway, heck, even Kuwait stocks are up double digits. But not just that, did you see the three-year returns? The US has an impressive 37% three-year gain. But look at some of these other countries. Argentina, 225%. Greece, 131%. Poland, over 100%. Italy, 90%. Just astonishing multi-year returns for many international markets. But the US stock market has had an extraordinary 15-year run, far outpacing international stocks during that time. One feature that's more prevalent to US stocks than anywhere else in the world: stock buybacks, where companies actually take cash and literally buy back their own shares, reducing the outstanding shares and increasing price and earnings per share. And the buyback machine is in full force, actually making a new all-time high in the first quarter at $293.5 billion, up a massive 20% from the previous quarter. And as I just mentioned, share buybacks help increase earnings per share, which in turn helps reduce this thing called PE ratio, which is a measure of how cheap or expensive the stock market is. The higher the PE ratio, the more expensive stocks are considered to be, as investors are paying more for the earnings. It's always a good reminder of what actually makes up the stock market return. Here we see the averages by decade, annual returns over here. So since the 80s, it's been good to be a long-term stock market investor. And so far, the 2020s tracking very close to the 2010s. But look at this. In the 80s and 90s, a growing PE ratio, or investors simply paying more for earnings, which was a large part of the gain. Much higher than last decade, and so far this decade too. Earnings, often considered the mother's milk of the stock market. Solid growth in the 80s, also high in the 90s, and much higher in the last 2 decades. Then of course we have dividends, which has ranged from over 5% in the 80s down to 1.2% in the 2000s, and then now back up to about 1.5% so far this decade. And today we'll leave you with this. Here's a look at a full house at Goldman Sachs Digital Assets Conference. These are institutions getting excited about digital assets. Thanks for joining us this week. Have a safe and joyful Independence Day, and we'll see you next Market Monday.